Hi, this is Steve Hutchinson with Hutchinson Family Office, and wanted to bring out a special video this month. This is, of course, November, and we're going to cover our list of topics that I go through each month, but this is a very special month. This is Veterans Day. It means a lot to me. It also means a lot to a lot of our clients who served and their families who had family who served as well. And also to the United States Marine Corps, the greatest fighting force in the whole world's birthday will be celebrated this month as well. So wishing all my Marine family members and all the veterans, thank you for everything you do. So let's go a little bit into what I do on every report. I like to talk about the employment report. I also like to talk about the Federal Reserve and the actions the Federal Reserve is taking as it pertains to the financial markets. And I also like to discuss major topics right now I see are inflation and tied to that energy. And I'm going to make another note here. I'm going to put down wages as well, because wages are starting to move up, and that's going to have an impact on inflation. We're going to talk a little bit about fiscal policy. Unless you've been sleeping under a rather large rock, you know that Congress is out there spending your money that you don't have yet, but they're spending it, and they're putting this back into what they call infrastructure. So we're going to talk a little bit about that, and then we'll discuss in general the financial markets. Now you see my trademark Monster drink is white today. You know, I'm neutral as far as the financial markets are concerned. We've seen the earnings. I'm pretty neutral at this particular point. I'm not blue for cold, and I'm not red for red hot. I'm kind of neutral right now. So we may see some creep up in the volatility by the end of the month, and we certainly hope so, because we've got positions on that capitalize on that. But anyway, let's talk about the employment numbers. It's hard to debate or not reconcile yourself that last month's employment report for October was so good. Over 500,000 new jobs. This was a tremendous report, and it goes a little deeper than that. It actually meant more upgrades for the previous 2 months. So if you sat back and look at the number of jobs that have been created in the last 3 months, or not created, or restored, if you will, because we went through a pandemic, has been tremendous. The unemployment rate has gone lower, and so we're seeing a very, very strong employment rate. But deep down in that employment rate, what we're seeing is wages going up. The problem, and we'll talk about this a little bit more, wages are going up, but so are the prices of goods and services, in other words, inflation. So the question becomes, are wages outpacing inflation? That rarely happens. We'll see what we got to talk about. Fed is finally, as we talked about over the last several months, is going to have to start tapering. Tapering means that they don't buy as many mortgage-backed securities. They don't buy as many government securities on the open market. I think they were buying something like $120 billion a month. They're going to cut that back to about less than 100, or whatever the number is. They're going to quit supporting low interest rates. Now, this does have an impact on the financial markets. It remains to be seen. It's not inflationary, but it will have an effect on the financial markets, in particular bond yields and things of that nature. But the Fed has got to go a lot further than just tapering. Remember, they've expanded their balance sheet since 2008 from a little over $1 trillion to over $8 trillion, and that has got to be made up somewhere. So we'll see how the Fed responds, but the Fed is in a little bit of a difficult situation. Their two primary objectives is first to control inflation and assist in employment. Well, the employment numbers are looking good, but the inflation numbers have kind of got them hamstrung. So we're going to see how this works out. Energy. A lot of conversation about energy. Gasoline prices is probably the number one way that we look at energy, but it goes much, much further than that. Heating oil, natural gas prices, all the components of energy production in the United States have doubled over the last year. This will have a significant inflationary impact on our country. Most people focus on what they have to pay at the pump, okay, and that's fair. But now we're getting into the cooler season, November, heat's coming on. We're going to start buying more natural gas. We're going to start buying heating oil. We're going to start paying or running our electric heaters more and paying more for electricity. So this will have an inflationary effect. We have upped our allocation gradually over the last couple months into more energy companies because we believe that the long-term process for energy or prospects for energy are probably on the higher side than the lower side. Some rumors that are coming out or conversations that come out in the news, pipeline restriction, things of this nature, is going to have a dampening effect on this. And as I've said many, many times, the financial markets don't really pay a lot of attention to elections. They pay attention to policy, and we're starting to see some of those policies manifest themselves. And whether the market greets this with a negative or positive impact remains to be seen. Let's talk about wages, though. This is, on one hand, this is really good. If you don't have much overhead, if your overhead is somewhat fixed, an increase in wages is very nice. But not many of us live in that world. We still have to go to the grocery store. We have to buy food. We got to buy meat. We got to buy bread. We got to buy milk. We got to stop at the gas station and get gas. And so the bottom line is, yeah, maybe wages are going up, but prices are going up with them. So we're not really seeing the wage inflation above the inflationary numbers or as far as cost of goods and services. And that does raise some concerns. And that, as I've said many times before, that leads me to believe that inflation is less transient than a lot of folks have been talking for the last 9 months. Now, some folks are blaming it on the supply chain. Well, we don't import turkeys. Let's just be straight up. We just don't import turkeys. And a lot of folks are going to have turkeys this Thanksgiving. Well, the price of turkeys is a lot higher, okay? Most of the turkeys you will eat in this area will come from the southeast. That's where turkeys come from. So what we're seeing is supply chain restrictions. We're having problems with trucking, getting truck drivers, enough truck drivers to move the goods and services across the country. And we're getting a continued demand as employment increases, as the economy continues to grow. There's going to be a greater demand for goods and services. As a result, it's expected we'll see inflation. Now, some folks have a tendency to believe that someone's going to wave a magic wand and this is all going to disappear. It's not that easy. It's not that easy. On a recent trip to Florida, I was absolutely amazed between my home in North Carolina and going down to Florida, the number of trucks heading into Charleston, heading into Savannah, where the ports are. It's amazing. So this is going to have an inflationary impact down the road, and I think it's something we have to be careful with. Let's talk about fiscal policy. Again, Congress, the House of Representatives finally passed the Senate version of the infrastructure bill. Now, remember that Senate version was passed in April of this year, and it just now got passed by the House. It was being held up by certain caucuses inside the Democratic Party, trying to tie two types of spending bills together. Now, the infrastructure bill, as it stands right now, seems like it's a pretty good bill, but it's a lot of money. It's about $1.2 trillion. And there's no reconciliation on how it's going to be paid for. And paid for really doesn't add up, because if our government debt keeps increasing and we keep telling ourselves that all these things are paid for, well, then why does the debt clock keep getting bigger and bigger? So things aren't really as paid for as we think they are, but they try to compensate it with tax increases. This one here, nothing really on a paid for side. So it's going to be interesting to see how that money filters in through the economy, infrastructure spending, roads, highways, bridges, whatever it may be. Maybe a few more places to plug your Tesla in. It remains to be seen. So fiscal policy is an issue. Now, there is a substantial spending bill that's in front of the House of Representatives right now, is yet to be voted on. They've trimmed it back from $3.5 trillion down to, I don't know, $1.5 or $2 trillion, or however it's structured. There are some significant concerns about this, not political, significant concerns. There are some things that they're doing in this bill that kind of raise eyebrows for me. They're unleashing the Internal Revenue Service on virtually everybody, and this never turns out good. And then we're also starting to see a lot of giveaways, and we're not. So this is more of a spending bill than an investing bill. So will it pass? That remains to be seen. I really don't dabble in what Congress will do. I just go by the old saying that no man, woman, or child is safe when Congress is in session. So where does that leave us with the financial markets? Well, as we get ready to sneak on into Christmas, and it's hard to believe in 2 more months it's going to be a new year. And we're going to put 2021 behind us, and we're going to be looking forward to 2022. Earnings are coming in very solid. We see good earnings coming in on all the companies. We think valuations for some of them are a little bit stretched. I would not be entirely surprised to see financial markets pull back on a 10 to 15% basis in the short run, but quite frankly, companies are well capitalized and we don't have excessive valuation. So in the point, I think the financial markets look good. So have a great Thanksgiving. I hope you enjoy your time with your family. Have a tremendous holiday. And let's hope that this economy continues to keep performing and we start seeing more and more people getting back to work and we see more businesses opening and more business owners and employees being successful. That'll do it for this month, and thank you for listening.